Question 1. Mr. Thompson, a 67-year-old Wisconsin resident, has just purchased a long-term care insurance policy. After a few years, he starts experiencing difficulty with two of his activities of daily living adults, dressing and bathing. His policy includes coverage for home care services, but it also has a 90-day elimination period. Mr. Thompson's family is eager to hire a home care aide to assist him immediately. Based on Wisconsin long-term care insurance regulations, what should Mr. Thompson expect regarding his benefits? A. Mr. Thompson will receive benefits immediately as he qualifies for LTC based on ADL impairments. B. Mr. Thompson must wait 90 days after filing a claim before his benefits will start due to the elimination period. C. Mr. Thompson can waive the elimination period for an additional premium payment and receive benefits right away. D. Mr. Thompson's policy will not cover home care services until he is unable to perform at least 4 adults. Answer. B. Mr. Thompson must wait 90 days after filing a claim before his benefits will start due to the elimination period. Explanation. Under Wisconsin regulations, the elimination period in a long-term care policy refers to the waiting period before benefits become payable. Even though Mr. Thompson qualifies for long-term care based on the inability to perform 2A DLS, which meets a common benefit trigger, his policy's 90-day elimination period means he must wait for that duration before his benefits will begin. This rule is standard unless the policy specifically allows for a waiver of the elimination period, which would need to be part of the policy provisions, and option C does not apply here. The policy covering home care based on 2A DLS is also correct, making option D incorrect. Question 2. Which of the following is not a type of inflation protection available for long-term care insurance policies in Wisconsin? A. Compound inflation protection. B. Simple inflation protection. C. Scheduled inflation protection. D. Guaranteed purchase option. GPO. Answer. C. Scheduled inflation protection. Explanation. Wisconsin long-term care insurance policies offer various forms of inflation protection to help policies keep up with increasing care costs over time. Compound inflation protection increases the benefit by a compounded percentage annually, while simple inflation protection increases benefits by a fixed percentage each year. The guaranteed purchase option GPO allows the policyholder to purchase additional coverage at a later date without evidence of insurability. However, scheduled inflation protection is not a recognized or common type of inflation protection option in Wisconsin long-term care insurance policies, making it the correct answer. Question 3. In Wisconsin, what is the purpose of the Long-Term Care Partnership Program in relation to Medicaid? A. To increase the minimum coverage standards for all LTC insurance policies. B. To allow individuals to protect more of their assets when applying for Medicaid after using LTC insurance. C. To provide federal tax credits for purchasing long-term care insurance. D. To mandate that all Wisconsin residents purchase long-term care insurance by age 65. Answer. B. To allow individuals to protect more of their assets when applying for Medicaid after using LTC insurance. Explanation. The Wisconsin Long-Term Care Partnership Program is designed to encourage individuals to purchase private long-term care insurance by offering the benefit of Medicaid asset protection. Under this program, policyholders can retain assets equal to the amount their long-term care insurance policy pays out in benefits without being subject to Medicaid spend-down requirements. The program does not increase minimum coverage standards. Option A. Provide federal tax credits. Option C. Or mandate LTC insurance purchases. Option D. Question 4. Ms. Adams, a 70-year-old Wisconsin resident, is considering purchasing a long-term care insurance policy. She wants a policy that will allow her to receive care at home and in an assisted living facility. However, Ms. Adams is also concerned about the rising costs of care over time. Which of the following policy provisions would best address Ms. Adams' concerns about increasing costs while maintaining her coverage for various care settings? A. Compound inflation protection and home care rider. B. Simple inflation protection and facility-only care. C. Return of premium rider and waiver of premium provision. D. Shared care rider and guaranteed purchase option. DP. Answer A. Compound inflation protection and home care rider. Explanation. Ms. Adams' concern about rising care costs can be best addressed through compound inflation protection, which increases her policy benefits annually based on a compounded percentage, ensuring her coverage keeps pace with inflation. Additionally, a home care rider ensures that her policy covers both home care and assisted living care. The other options either don't adequately address both inflation and coverage for different care settings, or they focus on benefits unrelated to inflation, e.g., return of premium or shared care riders. Question 5. Which of the following is an appropriate benefit trigger for receiving long-term care benefits under Wisconsin long-term care insurance policy? A. Inability to perform 3 or more activities of daily living adult. B. Loss of income due to disability. C. Cognitive impairment such as Alzheimer's disease. D. Hospitalization for a serious illness. Answer: C. Cognitive impairment such as Alzheimer's disease. Explanation: in Wisconsin, long-term care insurance policies typically have two primary benefit triggers: the inability to perform a certain number of activities of daily living adults, usually 2, and cognitive impairments such as Alzheimer's disease. While option 8 mentions adults, most policies require the inability to perform only 2 adults, not 3 or more, making it incorrect. Loss of income due to disability and hospitalization are not typical benefit triggers for long-term care policies, which focus on the need for extended personal care due to a DL impairment or cognitive decline. Question 6. In Wisconsin, what is the primary function of the free look period for long-term care insurance policies? A. It allows the insurer to cancel the policy if the applicant's health declines. B. It gives the policyholder a grace period to pay missed premiums without penalty. C. It provides the policyholder the option to review and cancel the policy for a full refund. D. It allows the policyholder to upgrade the policy without underwriting. Answer: C. It provides the policyholder the option to review and cancel the policy for a full refund. Explanation: the free look period is a consumer protection that allows a policyholder in Wisconsin to thoroughly review their long-term care insurance policy after purchase. If they decide they do not want the policy for any reason, they can cancel it within the specified period, usually 30 days, and receive a full refund. The free look period does not involve policy cancellation by the insurer, option A, nor does it relate to premium payments, option B, or policy upgrades, option D. Question 7. Which of the following riders on a Wisconsin long-term care insurance policy allows a surviving spouse to continue receiving benefits from a shared policy after the policyholder's death? A. Guaranteed purchase upper, GPO. B. Restoration of benefits rider. C. Survivor benefit rider. D. Waiver of premium provision. Answer: C. Survivor benefit rider. Explanation: the survivor benefit rider in long-term care insurance allows the surviving spouse to continue receiving benefits from the policy after the policyholder's death. This ensures continuity of coverage without the need for a new policy. The guaranteed purchase option, GPO, lets the policyholder purchase additional coverage without medical underwriting. The restoration of benefits rider restores benefits that were used if the policyholder recovers, and the waiver of premium provision waives premium payments while receiving benefits, none of which apply to survivor benefits. Question 8. Mr. Lewis, a 65-year-old, recently purchased a long-term care policy with a waiver of premium provision. After a few months, he becomes eligible to receive benefits due to cognitive impairment. His children are managing his care and expenses. When can they expect the premium payments to stop under the waiver of premium provision in Wisconsin? A. Premiums will stop immediately once benefits are triggered. B. Premiums will continue for 90 days after benefits begin. C. Premiums will stop after the elimination period ends. D. Premiums will continue for 1 year before the waiver of premium takes effect. Answer: C. Premiums will stop after the elimination period ends. Explanation: the waiver of premium provision in most long-term care policies, including those in Wisconsin, means that once the policyholder begins receiving benefits, they no longer need to pay premiums. However, this typically takes effect after the elimination period ends, which is the waiting period before benefits begin. Option C is correct because premium payments usually stop at this point. The other options either assume an immediate stop or a longer continuation of payments, which does not reflect standard policy terms. Question 9. Which of the following is a primary characteristic of a tax-qualified long-term care insurance policy in Wisconsin under IRS Section 7712A? Benefits received from the policy are considered taxable income. B. Premiums paid for the policy are not tax-deductible. C. The policyholder must be chronically ill to trigger benefits. D. The policy cannot include inflation protection. Answer: C. The policyholder must be chronically ill to trigger benefits. Explanation: under IRS Section 7712, which governs tax-qualified long-term care insurance policies, The policyholder must meet specific conditions to trigger benefits, such as being chronically ill, defined as requiring assistance with at least 2/8 DLS or having a severe cognitive impairment. The other options are incorrect because benefits from tax-qualified policies are not taxable income. Option A, premiums can be tax-deductible under certain conditions. Option B, an inflation protection can be included in tax-qualified policies. Option D. Question 10. Which of the following provisions is most commonly included in Wisconsin long-term care insurance policies to protect consumers from losing their coverage if they forget to pay their premium on time? A. Non-forfeiture provision. B. Incontestability clause. C. Grace period provision. D. Elimination period. Answer: C. Grace period provision. Explanation: the grace period provision is a consumer protection that allows the policyholder to maintain coverage if they miss a premium payment, typically providing an additional 31 days to make the payment before the policy lapses. This provision is standard in Wisconsin long-term care policies. Non-forfeiture provisions ensure that policyholders retain some value even if they stop paying premiums altogether. The incontestability clause protects against claim denials after a certain period of policy ownership, and the elimination period refers to the waiting period before benefits start, none of which relate to missing a premium payment. Question 11. In Wisconsin, long-term care insurance policies must meet certain minimum standards for policy benefits. Which of the following is one such standard? A. The policy must provide coverage for at least 60 days of care in a skilled nursing facility. B. The policy must offer a minimum lifetime benefit of $100,000. C. The policy must cover care in an assisted living facility. D. The policy must include inflation protection. Answer A. The policy must provide coverage for at least 60 days of care in a skilled nursing facility. Explanation: Wisconsin law mandates that long-term care insurance policies provide coverage for a minimum of 60 days of skilled nursing facility care. This is a standard protection to ensure that policyholders receive an adequate level of care when necessary. While policies may offer other benefits like inflation protection or coverage in an assisted living facility, these are not required for all policies. There is no requirement for a minimum lifetime benefit of $100,000. Option B, though policies often provide high benefit levels. Question 12. Which of the following is true regarding Wisconsin's long-term care inflation protection options? A. Wisconsin requires policies to include compound inflation protection by default. B. Wisconsin requires insurers to offer both simple and compound inflation protection to applicants. C. Inflation protection is only available for policyholders over the age of 70. D. Inflation protection is mandatory for all long-term care policies in Wisconsin. Answer: B. Wisconsin requires insurers to offer both simple and compound inflation protection to applicants. Explanation: in Wisconsin, insurers are required to offer both simple and compound inflation protection to policyholders, giving them options to help protect against the rising costs of care. Simple inflation protection increases benefits by a fixed percentage annually, while compound inflation protection increases benefits based on the increased value of the policy year over year. Inflation protection is not mandatory for all policies, nor is it restricted to policyholders over the age of 70. Options C and D. Question 13. Mr. Bennett has a Wisconsin long-term care policy with a 90-day elimination period and a maximum daily benefit of $150. After suffering a stroke, he needs care at a nursing home for an extended period. How much will the policy pay if Mr. Bennett spends 120 days in the nursing home and his daily costs amount to $180? A. $4,500. B. $7,500. C. $9,000. D. $18,000. Answer: C. $9,000. Explanation: Mr. Bennett's policy has a 90-day elimination period, meaning that no benefits are paid for the first 90 days of care. After the elimination period, the policy will cover his daily costs up to a maximum of $150 per day. He is in the nursing home for 120 days, but only the last 30 days are covered. 120 days. 90 equals 30 days. For those 30 days, the policy will pay $150 per day, resulting in a total of $150 times 3 equals $4,500. Thus, the correct amount the policy will pay is $9,000. Question 14. In Wisconsin, what is the purpose of the incontestability clause in a long-term care insurance policy? A. It prevents the insurer from cancelling the policy if premiums are missed for up to 90 days. B. It protects the policyholder from policy cancellation after 2 years except in cases of fraud. C. It allows the policyholder to cancel the policy without penalty within the first 30 days of coverage. D. It requires the insurer to pay all claims within a specific time frame. Answer: B. It protects the policyholder from policy cancellation after 2 years except in cases of fraud. Explanation: the incontestability clause in Wisconsin long-term care insurance policies prevents insurers from canceling or voiding the policy after it has been in force for 2 years except in cases of fraud. This means that after the initial 2-year period, the insurer cannot contest claims or deny coverage based on misstatements made in the application unless those misstatements were fraudulent. Options A, C, and D do not describe the function of the incontestability clause. Question 15. Which of the following accurately describes the Medicaid estate recovery program in Wisconsin as it relates to long-term care? A. It recovers Medicaid benefits paid for long-term care from the estates of deceased recipients. B. It allows Medicaid recipients to shield their home from recovery efforts after death. C. It only applies to estates valued at more than $1 million. D. It recovers Medicaid benefits from living beneficiaries after their 10-year anniversary of receiving benefits. Answer A. It recovers Medicaid benefits paid for long-term care from the estates of deceased recipients. Explanation: the Medicaid estate recovery program in Wisconsin allows the state to recover Medicaid benefits paid for long-term care services from the estate of a deceased recipient. This program ensures that assets in the estate are used to repay the costs of care that were covered by Medicaid. Option B is incorrect, as while certain protections exist for the home during the recipient's life, it is still subject to recovery after death unless specific exemptions apply. Question 16. Which of the following is an example of a non-forfeiture option available in long-term care insurance policies in Wisconsin? A. Waiver of premium. B. Reduced paid-up insurance. C. Elimination period. D. Guaranteed renewability. Answer: B. Reduced paid-up insurance. Explanation: a non-forfeiture option in long-term care insurance is a feature that allows the policyholder to retain some value in their policy if they stop paying premiums. Reduced paid-up insurance is a non-forfeiture option that provides the policyholder with reduced coverage without the need for further premium payments. This option ensures that the policyholder still has some protection, albeit at a low benefit level. The other choices, such as waiver of premium and elimination periods, are not non-forfeiture options. Question 17. In Wisconsin, how does the benefit trigger work in a long-term care insurance policy? A. The policyholder becomes eligible for benefits after meeting a specific financial threshold. B. Benefits are triggered once the policyholder is unable to perform 2 or more a DLS or has a cognitive impairment. C. Benefits are triggered immediately upon diagnosis of a chronic illness. D. The benefit trigger is based solely on the policyholder's age and premiums paid. Answer: B. Benefits are triggered once the policyholder is unable to perform 2 or more a DLS or has a cognitive impairment. Explanation: in Wisconsin long-term care policies, a benefit trigger typically occurs when the policyholder is unable to perform 2 or more activities of daily living, adults, e.g. bathing, dressing, eating, or suffers from a cognitive impairment, e.g. Alzheimer's disease. This is a common standard across the industry. The other options, such as meeting financial thresholds or basing the trigger on age or premium payments, do not apply to long-term care insurance policies. Question 18. Ms. Olson has a long-term care policy with a benefit trigger based on activities of daily living, adults. After being diagnosed with arthritis, she can no longer bathe or dress herself without assistance. However, she can still perform other DLS like eating and using the toilet. What should Ms. Olson expect in terms of her long-term care insurance benefits? A. She will not qualify for benefits because she can still perform more than 2 adults. B. She will qualify for benefits because she is unable to perform 2 adults. C. She will qualify for benefits after a waiting period of 6 months. D. She will not qualify for benefits unless she loses the ability to perform 3 or more adults. Answer: B. She will qualify for benefits because she is unable to perform 2 adults. Explanation: most Wisconsin long-term care policies require the inability to perform 2 or more a DLS to trigger benefits. Since Ms. Olson is unable to bathe and dress herself 2 adults, she qualifies for benefits under the typical policy provisions. There is no requirement to lose the ability to perform 3 or more a DLS. Option D, nor would there be a mandatory 6-month waiting period as suggested in option C. Question 19. Which of the following best describes restoration of benefits in a long-term care policy? A. The ability to restore the policy after it lapses due to non-payment of premiums. B. The restoration of benefits after the policyholder recovers from a qualifying condition and no longer requires care. C. The restoration of benefits to the full policy limit after a specified period of continuous care. D. The ability to use unused benefits from a deceased spouse's policy. Answer: B. The restoration of benefits after the policyholder recovers from a qualifying condition and no longer requires care. Explanation: restoration of benefits refers to a provision in long-term care policies that allows benefits to be restored after the policyholder recovers from the condition that required long-term care and they no longer require care. This means that once the policyholder has recovered sufficiently and does not need long-term care services anymore, they can have their benefits reinstated to their original level, allowing them to access coverage again if needed in the future. Option A refers to reinstatement of a policy rather than restoration of benefits. Option C misrepresents the concept, as benefits are not restored to the full limit after continuous care, rather they are reinstated once care is no longer needed. Option D does not pertain to the concept of restoration of benefits, as benefits from a deceased spouse's policy would generally not transfer to another individual. Question 20. What is a key consideration for the Wisconsin Long-Term Care Insurance Partnership Program? A. It mandates that all long-term care insurance policies must include a lifetime benefit option. B. It allows policyholders to protect assets equal to the amount of benefits received from Medicaid. C. It requires participants to be at least 75 years old to qualify for Medicaid benefits. D. It provides unlimited coverage for long-term care expenses without an elimination period. Answer: B. It allows policyholders to protect assets equal to the amount of benefits received from Medicaid. Explanation: the Wisconsin Long-Term Care Insurance Partnership Program is designed to encourage individuals to purchase long-term care insurance by allowing them to protect a certain amount of their assets when they apply for Medicaid. Specifically, for every dollar of long-term care benefits received from their insurance policy, policyholders can protect an equal amount in assets when applying for Medicaid, thus preventing asset depletion. Options A, C, and D are incorrect as they misrepresent the requirements and provisions of the partnership program. There is no age limit for applying for Medicaid benefits tied to this program, and it does not provide unlimited coverage without an elimination period. Question 21. In Wisconsin long-term care insurance, which of the following accurately reflects the waiting elimination period? A. It is the period during which the insured is not covered for any long-term care services. B. It is the duration a policyholder must wait before becoming eligible for benefits after a claim is filed. C. It is a mandatory time frame required by law before a policy can be sold. D. It refers to the time it takes for the insurer to process a claim after it is submitted. Answer: B. It is the duration a policyholder must wait before becoming eligible for benefits after a claim is filed. Explanation: the waiting or elimination period is the amount of time a policyholder must wait before benefits become payable under their long-term care insurance policy. This period typically starts once the insured has met the eligibility criteria for benefits. During this time, the policyholder is responsible for covering their own care costs. Options A, C, and D do not accurately describe the purpose of the waiting period. Question 22. What is a common feature of hybrid long-term care insurance policies? A. They provide coverage exclusively for nursing home care. B. They combine life insurance with long-term care benefits. C. They are not eligible for tax deductions. D. They require a longer elimination period than traditional policies. Answer: B. They combine life insurance with long-term care benefits. Explanation: hybrid long-term care insurance policies integrate life insurance and long-term care benefits into a single product. This structure allows policyholders to access benefits for long-term care needs while also providing a death benefit if the long-term care is not utilized. Option A is incorrect as hybrid policies cover various care types, not just nursing home care. Option C is also incorrect. Many hybrid policies qualify for tax deductions. Lastly, there is no standard requirement that hybrid policies have longer elimination periods than traditional policies. Option D. Question 23. When considering long-term care insurance in Wisconsin, which of the following is a suitability standard that producers must adhere to? A. Assessing the policyholder's interest in different types of coverage. B. Evaluating the policyholder's financial situation to determine if they can afford the premiums. C. Recommending the most expensive policy available on the market. D. Ensuring that the policyholder is under the age of 65. Answer: B. Evaluating the policyholder's financial situation to determine if they can afford the premiums. Explanation: suitability standards in long-term care insurance sales require producers to evaluate the financial situation of their clients to ensure they can afford the premiums of the policy being recommended. This helps prevent placing clients in policies that may lead to financial strain. Option A is too vague and does not reflect the financial assessment requirement. Option C contradicts ethical sales practices, and option D is not a requirement, as individuals older than 65 can also purchase long-term care insurance. Question 24. In the context of long-term care insurance in Wisconsin, what is meant by the term? A tax-qualified policy. A policy that allows for unlimited tax deductions on premiums paid. B. A policy that meets specific criteria under federal law, allowing benefits to be received tax-free. C. A policy that is exclusively available to individuals who have filed for bankruptcy. D. A policy that can only be sold by licensed tax professionals. Answer: B. A policy that meets specific criteria under federal law, allowing benefits to be received tax-free. Explanation: a tax-qualified policy is one that meets the requirements set forth by the IRS under Section 7712 of the Internal Revenue Code, which allows for the benefits to be received tax-free by the policyholder. Premiums paid on such policies may also be tax-deductible, subject to certain limits. Options A, C, and D misrepresent the nature and regulations surrounding tax-qualified policies. Question 25. Which of the following factors is not typically used to determine premiums for long-term care insurance in Wisconsin? A. The applicant's age at the time of application. B. The applicant's gender. C. The applicant's credit score. D. The applicant's health status. Answer: C. The applicant's credit score. Explanation: while age, gender, and health status are significant factors influencing long-term care insurance premiums, an applicant's credit score is not a standard consideration in determining premiums. Insurers focus on health and demographic factors that affect risk rather than financial status. Therefore, option C is correct, as it is not typically used in the premium setting process. Question 26. Mrs. Garcia is considering purchasing a long-term care insurance policy in Wisconsin. She is 68 years old and has a family history of Alzheimer's disease. After discussing with her insurance agent, she decides on a policy with a 5% compound inflation rider. What should Mrs. Garcia understand about the implications of choosing this rider for her policy? A. Her premiums will decrease each year as the inflation rider is activated. B. The benefits will increase by 5% annually compounded, which can help cover rising long-term care costs. C. She will only be eligible for benefits if she pays additional premiums every year. D. The inflation rider will only apply if she files a claim within the first 5 years. Answer: B. The benefits will increase by 5% annually compounded, which can help cover rising long-term care costs. Explanation: choosing a 5% compound inflation rider means that the daily benefits of Mrs. Garcia's policy will increase by 5% each year compounded. This is crucial for keeping pace with the rising costs of long-term care services over time. Option A is incorrect because premiums typically do not decrease due to inflation riders. Option C misrepresents the rider's functionality, and option D incorrectly implies a limitation on when the inflation rider applies. Question 27. What is the primary purpose of the free look period in long-term care insurance policies in Wisconsin? A. It allows policyholders to review their benefits after they have been approved for coverage. B. It gives policyholders a chance to cancel their policy for a full refund within a specified time after purchase. C. It mandates a waiting period before benefits can be claimed. D. It allows insurers to revise their premiums without notice to the policyholder. Answer: B. It gives policyholders a chance to cancel their policy for a full refund within a specified time after purchase. Explanation: the free look period provides policyholders with a specified number of days, usually 10 to 30 days, to review their policy after purchase and decide whether to keep it. If they choose to cancel within this time, they are entitled to a full refund of any premiums paid. This consumer protection allows for informed decision-making. Option A describes a different process, while options C and D do not pertain to the free look provision. Question 20. Which of the following is a critical requirement for filing a long-term care insurance claim in Wisconsin? A. The policyholder must have a designated caregiver who files on their behalf. B. The policyholder must submit a copy of their last 2 tax returns with the claim. C. The policyholder must provide documentation of their care needs, such as a care plan from a licensed health professional. D. The policyholder must wait at least 30 days after submitting the claim for any benefits to be paid. Answer: C. The policyholder must provide documentation of their care needs, such as a care plan from a licensed health professional. Explanation: when filing a long-term care insurance claim, policyholders are required to provide documentation of their care needs. This often includes a care plan from a licensed health professional that outlines the necessity for long-term care services. Option A is incorrect because the policyholder can file the claim directly. Option B is not a standard requirement for claims processing, and option D is misleading as claims should be processed promptly based on policy terms. Question 29. What is the purpose of the Long-Term Care Partnership Program in Wisconsin? A. To provide state-funded long-term care for all residents over age 65. B. To promote the purchase of long-term care insurance and protect assets from Medicaid recovery. C. To regulate the premium rates for long-term care insurance sold in the state. D. To require all long-term care facilities to accept Medicaid. Answer: B. To promote the purchase of long-term care insurance and protect assets from Medicaid recovery. Explanation: the Long-Term Care Partnership Program is designed to encourage individuals to purchase long-term care insurance by allowing them to protect assets equal to the amount of benefits received from their insurance when applying for Medicaid. This creates a financial incentive for people to secure insurance coverage for potential long-term care needs while ensuring they can retain some assets. Options A, C, and D mischaracterize the program's purpose. Question 30. Which of the following is a key consumer protection feature in long-term care insurance policies in Wisconsin? A. A mandatory 90-day waiting period before any benefits can be claimed. B. The inclusion of a guaranteed renewability provision ensuring the policy cannot be cancelled as long as premiums are paid. C. The requirement that premiums increase every 5 years based on the policyholder's age. D. The option for insurers to change coverage terms without notice to the policyholder. Answer: B. The inclusion of a guaranteed renewability provision ensuring the policy cannot be cancelled as long as premiums are paid. Explanation: a guaranteed renewability provision is a critical consumer protection feature in long-term care insurance policies. It ensures that the insurer cannot cancel the policy as long as the premiums are paid on time. This provision protects consumers from losing their coverage unexpectedly due to factors beyond their control, such as health changes. Option A incorrectly describes a consumer protection feature, while option C misrepresents premium structures. Option D would not be in the best interest of consumers and is therefore not a protection.